The Sydney property boom is over. Well, at least that's what the media tell us. That's what we're going to discuss today in this bonus episode of my show.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
The media is full of stories about the end of the Sydney property boom. So what should you do with so much speculation and mixed messages? Is it too late to get in? Should you sell up? Should you regret having recently bought a property in Sydney? Or maybe it's the right time to take advantage while other people are sitting on the sidelines. That's exactly what we're going to discuss in this bonus episode of my show. I've put this together in between the regular weekly shows because there's just so many questions to ask, and I'm going to be joined by senior property strategist at Metropolitan Sydney, Ahmed Imam, who's going to give me some information about what's happening on the ground. Welcome, Ahmed.
Hi, Michael. Pleasure to be here. Thank you.
I bet you're hearing that all the time. Is the boom over? What's ahead? What's going on?
Oh, it's all I hear at the moment. I think the general consensus is that people are fearful, but that's what this video is all about. Hopefully we can address that.
Okay, well, let's be blunt. Let's start off right from the beginning. Yes, sure. The boom is over. But that doesn't mean the property market's about to crash. It doesn't mean that the value of your house or your investment property is going to dive. Interestingly, I'm happy the boom is over because if it kept going at the rate it was, we would have had a much bigger crash. So what's ahead? I'm going to give you my thoughts about that in just a moment. But let's start off with talking a bit about what's actually going on the ground. You've got your team on the ground there. What's happening in Sydney, Ahmed?
Yeah, look, the last 4 to 5 years of growth has been Sydney's peak rate of growth. The capital gains in the housing market has been losing momentum since, say, late 2016, early 2017, and conditions in October were reasonably flat. But there's no doubt that if we take the last 12 months into consideration, the growth in the inner middle rings has outperformed the growth in the outer rings. But I find it very ironic, Michael, that when the housing market is booming, people are generally scared that it's going to crash, and so they hold and they don't buy. And then when the market softens, like it's doing now, people hold and they don't buy because they're waiting for it to boom again. So when exactly is the right time to buy is the question.
That's interesting. So let's be fair. Prices have been flat for the second half of the year, but they haven't fallen in most of Sydney. There's a couple of areas, particularly the higher end market, which is having a few problems, and the cheaper, lower socioeconomic areas that are having a few challenges as well. But I think what's scaring people, Ahmed, is all the mixed messages. So a year or two ago, all the news was high property price growth, high auction clearance rates. Every week your house has gone up $2,000 and you didn't have to do anything about it. And during flat times, there's all the negative messages. But at this time, as the market changes cycle to the next phase, it's common to get mixed messages, but people aren't aware of that, so they're getting concerned.
I think the naysayers come out at the same time every year, Michael, especially in these conditions. And they start to scream words like the market's crashing and the bubble is bursting and it's a bust, and it scares the daylight out of most people. And when people are fearful, they tend to hold and procrastinate. It's kind of like a deer in the headlights. The market is not crashing. The bubble is not bursting. There's no doubt the market has slowed down. We're not doubting that. But we're talking about growth from double digits to growth that's at realistic levels, and as you mentioned, it's now nice, stable, linear, predictable growth, which as investors we like because it's less volatile.
I guess we've gone from fifth gear to second gear, but it's fragmented in Sydney. And an example I often use is it's a bit like putting one hand in a bucket of cold water and the other hand in a bucket of warm water, and on average saying, look, it's okay. There are some segments of the Sydney market that are suffering a bit and a bit cold, and some segments of the Sydney market that are still More than warm. I know our buyers agents on the ground are saying that they still attend auctions in certain locations for certain types of property, and there are still multiple buyers pushing them up well above the reserve.
Yeah, that's right. It's definitely a fragmented market. We've got the market separated by demographics and geography and socioeconomics, and as we've touched on, we've got secondary CBDs like Parramatta and Chatswood and Liverpool. They all perform differently and at different levels. And so when we're talking about growth slowing down, it's growth on average across all those markets. But we have to also keep in consideration that growth in certain pockets, the right pockets, will always outperform.
So, Ahmed, what's caused the slowdown? Why is it happening?
Yeah, look, we've seen restrictions by APRA. And APRA is the Australian Prudential Regulation Authority, and they're the regulator of the Australian financial services industry. To put it very simply, they realised that it got to a stage where 40% of borrowers were on interest-only loans, as in they weren't paying down any debt, which of course has an impact on the overall economy. So APRA put mandates on the banks and the lenders to reduce that quota to 30% and to do it pretty quickly. So as a result, we're seeing tighter lending conditions. The banks are trying to reduce the amount of interest-only loans they're giving out. The banks are forcing people into principal and interest loans when previously they were on interest-only loans. They're having people pay larger deposits from, say, 10% to 20%. And so the people who have saved $60,000 for a 10% deposit are now being told they need $120K. People who are just making ends meet on an interest-only payment are now being forced into a principal and interest payment, and as a result, they're struggling. And that's why people are now talking about affordability constraints.
Well, I think one of the big challenges is really getting the deposit in Sydney. So while interest rates are still relatively low and it's easy to keep paying the mortgage, it's actually getting that bigger deposit that's stopping people getting into Sydney, combined with the fact that banks are making it harder for investors to borrow because of the serviceability criteria they're now putting on them. In other words, they've got to be able to show that they can repay loans at 7.5%, 8% in principal and interest, as you said, even if that's not the loan that they're taking out. So both those segments of the markets, the first home buyers are having trouble because of the bigger deposit constraints. Investors are also. So they're two sectors that have slowed the lower end of the market. I think the other thing I've noticed is that the home buyers who were upgrading because the market was doing well, as the year progressed, started to feel a little bit uncertain. They weren't sure, should I buy first, should I sell first? I'm going to sell my house, but I've got to pay a lot of stamp duty on the next one. So the tendency seems to be that the middle ring upgraders have been a bit more cautious this year and decided to stay put and spend the money renovating their current premises rather than spending it on stamp duty. And so they've been holding back, and there's been fewer good properties on the market as well. So a number of factors have led to this, but it's not been what leads to a crash. A crash is very different.
No, it's not leading to a crash at all, Michael. And look, Michael, I think it's fair to say you're a little bit older than I am, just a little bit. And I'm not going to stress that point because I really do enjoy employment. But you've been investing now for 40 years. I mean, you've seen 4 to 5 property cycles. You've experienced the 2009 post-GFC, the recession in 2003, the high interest rates in the late 80s, and all of those conditions were much worse than what we're seeing now. So it's probably a good idea to put things into perspective. So in your opinion, what's likely to happen to Sydney property prices over the next year?
Well, why I don't think it's going to crash is because to make a property market crash, in other words, property prices to drop significantly, people have to sell their homes and not have anyone able or willing to buy them. So that would mean you'd either need exceedingly high unemployment so that people have to sell their homes and can't keep their mortgages, and no one's suggesting that because Sydney's creating more jobs than anywhere else in Australia. Number two, you need exceedingly high interest rates where, again, people can't keep up their mortgages and have to sell, and new people can't buy their houses because mortgage rates are so high. No one's predicting that. You need a depression, not a recession of 1 or 2 quarters where there's going to be low or negative GDP growth, and no one's suggesting we're going to have a recession or a depression. or you'd need a very tight credit squeeze where no one can get finance, and that's not happening. APRA's doing it in a very smart, regulated way. Or the other cause of a crash is where there's significant oversupply, and other than in certain markets around Australia, that's not the case. So what's likely to happen, Ahmed, is a more regulated slowdown, because what's happening this time is that we're getting the slowdown in a relatively low interest rate environment. Every other cycle I've invested in, it's either been a credit squeeze, which is a bit like we're having now, where you can't get finance, or exceedingly high interest rates that stop the market. This slowdown is now going to allow the Reserve Bank to keep interest rates low for a while longer. They don't have to raise interest rates, which means that homeowners aren't going to have to find more. They're not going to have trouble meeting their mortgages. Businesses are going to have low interest rates so they can invest. The economy should be able to go on because people can spend. So I see, in Sydney in particular, a year of more moderate growth. It does depend upon what the Reserve Bank does to interest rates. I don't think they're going to go up. It does depend upon what APRA is going to do for lending criteria. And it's likely that they're now going to leave us alone because they've done their job. And to be honest, they've done their job well. They've restricted things. And as an investor, I don't particularly like it. And I know it's affected you personally, financially too. If you've got a lot of properties, it's just harder to borrow. But it's actually slowed us down, which means we're not going to have the drop that we may have experienced if the property values kept going up. So even if property values do drop a little bit, in the GFC they dropped 4 or 5%. In 2002-3 in Sydney, they dropped about 8%, but not overnight, over 18 months. If they drop 5%, Ahmed, it's only back to where it was at the beginning of the year, and then the prices are going to go on. I think different segments are going to be affected differently. I mean, the high end of the market, the very expensive trophy homes, are going to suffer. They always do at this stage of the cycle. The lower end, the more working class blue collar areas are also going to suffer. A lot of young families have borrowed to the hilt to get their first home, as a lot of us did when we had to buy our first home. But then they've gone to Harvey Norman or JB Hi-Fi and bought the television package and the furniture package on 3 years interest free, and all of a sudden that time's going to come up and they're suddenly going to find they've got to pay 20%, 22% on their credit cards. They're the areas that suffer a little bit more when interest rates go up, when petrol prices go up, when job opportunities go down. And they're the areas where jobs are not being created as much. We're creating the jobs in the financial and the service industries, and they're the areas where wages growth isn't going up. The workers, unfortunately, aren't getting a wages growth, while in the financial service industry it is. So those areas in the middle and inner ring suburbs where people's wages are going up, where jobs are being created, where the migrants are coming, 55% of our population growth is related to migrants coming in, and they're at household formation age. That's still going to drive certain segments of the property market and underpin the Sydney property market. So we're in for a couple of years of lower growth. In my mind, more stable markets and ones that will be easier to take advantage of, because other people are going to sit on the sidelines wondering what's going on.
Yeah, so the wider population is definitely fearful at these times, and people are holding and they're procrastinating. Okay, so Michael, what can investors do to take advantage of these times that we're seeing at the moment?
Firstly, they've got to get their strategy right. This is not the time to suddenly swap strategies and go for cash flow because capital growth isn't there, because capital growth is what's going to get you out of the rat race. Cash flow is important to keep you in, but when you retire in 10, 15 years' time, whenever it is, most of your asset isn't going to be money you've saved. It's not going to be rent that you got. It's not going to be cash flow. It's going to be the capital growth of your properties. So step one is retain the right property strategy, which is a capital growth strategy. Step two is to have realistic expectations, knowing that the property market moves in cycles. And this is the stage of the cycle where lifetime money is made when people take advantage of buying good properties that are going to see them through their lifetime. Step three is to get a good team around you, get a good advisor to tell you the right ownership structures, get a great finance strategist who helps you through the maze of the banks at the moment. Get a good property strategist who've got their feet on the ground and understand what's going on, and some good property managers to look after you. It's too hard and too lonely to do it on your own, Ahmed.
Yeah, I agree. And I think this is a time where some serious costly mistakes can be made. There's no doubt that there's very high entry fees and very high exit fees when you're buying property. So it's time to be very selective and very conscious of the fact that you do need experts on your side.
So if people want to have a chat with you and your team, they should go to metropole.com.au and make an inquiry, or 1300 Metropole, give us a call. We'd love to have a chat with you. We'd love to see how your portfolio is performing. So whether you're a beginning investor wondering, is it too late? Well, it is for some areas, but not for others. Or if you're an experienced investor wondering how your portfolio is performing, give the team at Metropole a call, 1300 Metropole, or go to the website metropole.com.au, and we'd love to assess how your portfolio is performing or help you formulate a plan. Thanks for taking the time to have a chat, Ahmed.
Always a pleasure, Michael. Thank you.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success, and money in around 20 minutes.